The global truck market is entering 2026 under tightening credit conditions, rising inventory levels, and weakening consumer demand. Higher interest rates have crushed affordability, while aggressive electrification spending has burned through billions in capital with limited returns. Several truck brands are not merely facing a cyclical slowdown, they are confronting structural financial stress that threatens their long-term survival. Mounting debt, collapsing infrastructure, shrinking dealer networks, and deteriorating resale values are forming a dangerous feedback loop. Below are 6 trucks that carry elevated financial and operational risk heading into 2026. These are not temporary headwinds, these are red flags. Ram 1500. The first warning sign sits inside Stellantis NFV. The parent company of Ram Trucks has been under severe pressure in North America. Dealer inventories have risen, incentive spending has expanded, and profit margins have narrowed. The Ram 1500 remains a high-volume model, but volume alone does not equal stability. Stellantis has been balancing aggressive electrification spending with shareholder payout commitments. That capital allocation strategy becomes dangerous when cash flow slows. Rising inventory days signal demand misalignment. If production remains elevated while retail sales cool, discounting accelerates. Discounting weakens residual values. Lower residual values undermine leasing economics and brand equity. Debt sustainability is the underlying concern. Stellantis has relied heavily on North American profits to subsidize European transitions and electric vehicle programs. If the Ram 1500 loses pricing power, that subsidy weakens. Suppliers begin to feel payment pressure. Dealers face slower floor plan turnover. Once confidence erodes in a truck brand, rebuilding it is expensive and slow. Nissan Titan. 4. The Nissan Titan represents a retreat more than a fight. Nissan Motor Company has already signaled withdrawal from the full-size truck competition in North America. Declining market share, weak brand positioning, and poor resale performance have pushed the Titan toward discontinuation. From a financial standpoint, exiting a segment is often a liquidity preservation move. It reflects an inability to justify further capital investment. The Titan never achieved the scale required to spread development and manufacturing costs efficiently. Underutilized plants increase per-unit cost. Low residual values increase lease losses. Incentives rise to clear aging inventory. The broader issue is Nissan corporate leverage. The company has been restructuring for years, navigating thin margins and strategic drift. When a manufacturer shrinks its product portfolio under financial stress, dealer confidence erodes. Once dealers begin reallocating showroom space and marketing dollars to stronger brands, the downward spiral accelerates. For consumers, a truck that loses corporate backing risks parts delays, reduced aftermarket support, and depressed resale value. Discontinuation is not merely symbolic. It signals capital exhaustion in that segment. Please subscribe to our channel. We want to reach 1,000 subscribers this week. Rivian R1T. The Rivian R1T entered the market with strong branding and early investor enthusiasm. However, enthusiasm does not equal sustainable cash flow. Rivian Automotive has reported substantial operating losses as it attempts to scale production. Capital intensity is the central risk. Development of electric pickup trucks requires enormous upfront investment in battery supply chains, software integration, and manufacturing automation. If unit sales plateau while fixed costs remain high, burn rates accelerate. Rivian has relied on capital markets to fund expansion. In a tighter credit environment, refinancing becomes more expensive and equity dilution becomes more painful. Service infrastructure remains thin compared to legacy manufacturers. Limited service centers create consumer hesitation. That hesitation reduces demand. Lower demand increases per unit cost. The cycle reinforces itself. Residual value trends also matter. If early R1T units depreciate faster than expected, leasing partners pull back. Financing becomes more restrictive. Without affordable financing, a premium electric truck faces shrinking addressable demand. Nikola Tre. The Nikola Tre is tied directly to the financial credibility of Nikola Corporation. Nikola has faced governance crises, leadership turnover, and extreme volatility in market valuation. Commercial truck startups operate on thin margins, even in strong freight markets. When freight demand weakens, fleet operators delay purchases, and that delay is devastating for a company with limited cash reserves and high production costs. Nikola has attempted to build hydrogen and battery electric platforms simultaneously. That dual strategy strains capital allocation. Infrastructure for hydrogen remains sparse and expensive, and battery electric heavy trucks require high-density charging networks that are not yet widespread. Supplier confidence is fragile in these circumstances. If suppliers demand stricter payment terms because of perceived credit risk, working capital requirements increase and liquidity tightens. The path toward restructuring becomes shorter. For fleet buyers, the risk is operational continuity. A truck manufacturer under financial distress may struggle to provide long-term parts availability and warranty support. In commercial operations, downtime is cost, and uncertainty is cost. The Lordstown Endurance is closely associated with the financial collapse of Lordstown Motors. Once positioned as a fleet-focused electric pickup challenger, the company struggled with production delays, capital shortages, and credibility concerns. Scaling automotive manufacturing is unforgiving. Tooling costs, supplier contracts, and certification expenses demand deep liquidity. Lordstown faced repeated warnings about its ability to continue operations. When a manufacturer signals doubt about its own survival, counterparties retreat. Suppliers demand upfront payment. Dealers hesitate. Customers cancel orders. Even if production resumes under new ownership or restructuring, brand damage is lasting. Fleet buyers require predictable service networks and stable corporate backing. The Endurance platform lacks both. Residual value collapse is almost guaranteed when bankruptcy risk becomes public. For consumers or small businesses considering a niche electric truck, the Endurance case demonstrates the brutal math of undercapitalized manufacturing ventures. Bollinger B2-4. The Bollinger B2 reflects ambition without proven scale. Bollinger Motors positioned itself as a rugged electric utility brand. However, prototype enthusiasm does not guarantee sustained production viability. Development delays, shifting business strategies, and capital constraints have repeatedly challenged the company. Small volume, specialty manufacturing often faces the harshest financing conditions. Without scale, per-unit costs remain elevated, and elevated costs limit competitive pricing. Limited pricing power restricts demand. If external investors hesitate to provide further capital infusions, expansion stalls. When expansion stalls, fixed costs can dominate financial statements. Insolvency risk rises quickly in that environment. The infrastructure challenge is equally serious. Service networks are minimal. Parts pipelines are uncertain. Insurance underwriting for low-volume electric trucks can be more restrictive due to limited historical data. Consumer red alert. Across these 6 trucks, the common denominator is financial fragility. Whether it is legacy pressure at Stellantis affecting Ram, strategic retreat at Nissan, capital burn at Rivian, governance and liquidity risk at Nikola, collapse at Lordstown, or scaling uncertainty at Bollinger, the pattern is consistent. Mounting debt reduces flexibility. Collapsing infrastructure weakens customer confidence. Bankruptcy risk accelerates when refinancing windows narrow. For consumers, the danger is not theoretical. A financially stressed manufacturer often responds with aggressive discounting to move inventory. While that may appear attractive, it usually signals margin compression and inventory imbalance. Discounted trucks today may translate into weak resale values tomorrow. Dealer networks matter. When dealers exit a brand due to low profitability or an uncertain product pipeline, service accessibility declines. Longer service wait times reduce owner satisfaction. Negative sentiment spreads quickly in online communities, and that sentiment impacts demand. Suppliers also react to credit risk. If suppliers shorten payment terms or raise prices due to perceived instability, production costs increase. Higher costs squeeze margins further. In extreme cases, parts shortages emerge not from logistics constraints, but from unpaid invoices. Credit ratings are an underappreciated signal. Downgrades increase borrowing costs. Higher borrowing costs accelerate cash burn. When capital markets close or become prohibitively expensive, even established brands can face forced asset sales or strategic mergers. Electric truck programs carry particular exposure. Battery investments are capital-heavy and sensitive to commodity pricing. If expected volume does not materialize, factories become underutilized assets, generating depreciation without sufficient revenue. Consumers considering any truck purchase in 2026 must look beyond horsepower and towing capacity. Review corporate earnings, examine debt levels, watch for plant closures, layoffs, or canceled programs. These are not minor adjustments, they are early warnings of structural decline. The automotive industry has always been cyclical, but the current environment combines high capital expenditure, tightening liquidity, and shifting regulatory pressures. Not every brand will survive intact. Some will restructure, some will be acquired, some will disappear. Buying a truck from a financially unstable manufacturer transfers part of that risk to the consumer. Warranty promises depend on corporate solvency. Software updates depend on engineering budgets. Parts availability depends on supplier confidence. In 2026, caution is not pessimism, it is rational risk management. Please subscribe to our channel. We want to hit 1,000 subscribers this week.